Well, good afternoon, everybody. My name is Tony Lajeunesse. I am the president and CEO of TL Financial Group. Thank you so much for attending our webinar today. We're going to be reviewing some really important updates related to the Secure Act and really what you need to know regarding the details of these changes, and they're really important. We've been really eager to share this information with you for some time. This act was actually passed in December of 2019. And myself, Michelle, and Aaron, the other advisors at our office, took an in-depth training course on this subject in February of this year. But due to the COVID pandemic, we've really been delayed, obviously, in getting this information out to you. So we're really glad that you're attending today. But before I begin, I do want to remind you that today's webinar has everyone on mute. So if you do have questions, please feel free to email myself, Michelle, or Aaron, and we'll reply promptly. Also, there will be a recording of today's webinar, and it will be emailed to all of our clients and those that have registered. The replay will also be posted on our website and Facebook page at TL Financial Group. So if you haven't already, please visit our page to follow us. Also, please feel free to share the replay with a colleague, friend, or family member that you feel that could benefit from this information. As you'll see in just a moment, this new Secure Act will impact many areas of retirement planning that will affect how we plan for the future. So let's go ahead and begin. So today's topic, of course, is the Secure Act and the changes it brings to all the retirement rules. So I think that tax education is very important. And so over the years, I've seen people and families make poor decisions about their taxes as it relates to their financial planning. So I'd rather be proactive in this area and prudently plan for the future, hence why this information is so important and how it may relate to you and your unique situation. So you should have received our presentation slides along with the new Rules Secure Act fact sheet and another informational sheet as well. And you can use that to reference and also follow along. So let's take a look here. I keep hitting this here. All right. So let's take a look at the core challenge we're all facing. The Secure Act changes the retirement rules for individuals and companies, which means current and future retirement plans need to be reviewed and adjusted. Funding your retirement is likely one of the biggest financial challenges you're going to encounter in your life. You may buy a house, start a family, send your kids to college, and then somehow need money to live for the next 20 to 30 years without a paycheck. So it's enough to make anyone stressed out. So as if that weren't enough, the government has all sorts of rules how you can save for your money and when you can or cannot take that money out. So sometimes there's a penalty for withdrawing money before a certain age. Sometimes you have to withdraw funds even if you don't need them and would rather stay invested. A lot of people don't know enough about these rules and they end up making mistakes which can hurt their financial plans. So not to mention the idea of retirement is changing. The boomer generation is going into retirement and many have not saved enough money to live comfortably. Lifespans are getting longer and people are putting off retirement, whether because they want to or because they have to. Younger generations pull income from multiple sources and jobs throughout their lives, so the old rules aren't applicable anymore. Those are the driving forces behind the Secure Act, which changes the retirement rules for both individuals and companies. No matter where you are in retirement savings, current and future plans need to be reviewed and adjusted. This is something that we will be discussing with all of our clients as it pertains to their individual needs. Many planning strategies will need to be modified, updated, or changed. And each individual has their own unique financial situation. That's why providing customized based advice is so important, which is why we're here for you. Okay, what you're seeing right now is some tax disclosing information for you. As a comprehensive financial planning firm, we provide an array of planning services for our clients, including tax planning, but we're not CPAs, okay? Therefore, you or I will want to consult with your tax professional when addressing your unique individual tax situation. As you can see here, for traditional IRAs, you must pay taxes on distributions or conversions at ordinary federal and state rates. For Roth IRAs, which are non-deductible, money has the potential to grow tax-free, and earnings may be withdrawn tax-free in accordance with the IRS rules. And for state taxes, this presentation references just federal taxes, so you still may have to pay some state taxes, so you want to check with your tax professional on that as well. All right, the Secure Act was finally signed into law in December of 2019. After a long time in legislative limbo, believe it or not, it's the biggest retirement-related legislation change in over a decade, and it had bipartisan support. Congress realized that retirement rules needed to be updated for all the reasons we just discussed. The impact is really far-reaching, from the silent generation and boomers who are thinking about estate plans, to boomers and Gen X focused on retirement, and to millennials and Generation Z, who will be the recipients of a great wealth transfer in the next few decades. Like I said, everyone will need to reevaluate their financial plans as a result of this act. Taxes are more complicated than you probably realize, and a key part of your savings, investments, and retirement plans. So if you don't plan ahead, you're going to miss out on saving opportunities and possibly pay more in taxes than necessary. In addition, the government sees businesses as having a continued and expanded role promoting retirement savings by their employees. And I want to make sure you understand how the changes will impact you, your family, and if relevant, your business, which is where we'll start first. Now, you may be thinking, I don't run a business, so how does this aspect of the Secure Act really relate to me? It's a good question. So let's take a look at some of the details. The workplace is where retirement savings begins. So these new rules are important to everybody. The Secure Act is about promoting better retirement savings, and there's a clear role for employers. Our first key is businesses have more incentive to create retirement plans and promote greater participation by their employees. According to the US Census Bureau, 98.2% of American employers have fewer than 100 workers, which is how the IRS defines a small business. So this next item is a lot more important than what you might see. Congress is authorizing more help for small businesses in the form of tax credits. Small businesses who start a retirement plan can now claim a credit of up to $5,000 for up to 3 years to help with startup costs. This is a substantial increase from the previous $500 credit that was available. In addition, small businesses who adopt an auto-enrollment retirement plan can claim another $500 for 3 years, separate from the credit mentioned above. This applies not only to brand new retirement plans, but any existing ones who adopt the auto-enrollment option. So hopefully these tax credits will encourage more employers to offer retirement plans, which in turn allows more Americans to save. And if you think it might affect you, talk to your employer or HR director about what they might be doing. As we know, pensions are a thing of the past, and so saving for retirement through these retirement plans is very important. Now, in an effort to encourage and increase retirement savings, some employers are using auto-enrollment for their 401k plans. That means new hires are automatically enrolled in the plan and must opt out instead of opting in. Studies have shown that auto-enrollment is increasing 401k balances, so Congress wants to continue the good work. Companies that auto-enroll can slowly increase the percentage saved each year, again, unless the employee opts out. Previously, 10% of a salary was the maximum that could be automatically deferred. Now employers can set the default to 15% of an employee's salary. This might be a good time to look at your own 401k savings and consider if you're saving enough. Is that the right place to put your retirement savings? How much will your employer match? Those are all things to consider. Now, companies now have more freedom to offer annuities inside 401k plans because the Secure Act reduces risk to employers. Before, many plans avoided offering lifetime income annuities as investment options because they feared that the annuity carrier might go out of business and the plan would be held responsible. The easy way to explain the change is that a safe harbor was created, and as long as the plan provider does due diligence in selecting the annuity provider, they won't be held liable. Why is this important to you? One of the hardest parts of retirement income is making your lump sum savings last throughout the rest of your life. Annuities are insurance products designed to turn a portion of savings into lifetime income streams. Annuities can be really complicated, so this is definitely something that you'll want to get some advice on as you plan your retirement income strategy. Now, our next point is somewhat related to annuities. Employee 401k statements must now include a lifetime income disclosure instead of what you usually see now, which is just your current lump sum amount. The ability to see how much their savings would be when translated into a monthly income stream will hopefully help many savers plan better for retirement. You'll see that lifetime income disclosures, at least yearly in your 401k statements, that might wake some people up and encourage them to save more. Of course, it's impossible to know how long your retirement savings will last, and everyone retires at different ages, but these new disclosures will hopefully give people an idea where they stand in terms of saving for retirement. Now, that last point about having an income stream in retirement may strike a chord and prompt you to ask, what key items in the SECURE Act will specifically impact me and my plans for retirement? And so now we look at number 2. And here's the answer and your next key. You now have more time to save for retirement and more ways to save and more ways to use the funds. Firstly, there is no more maximum contribution age for individual retirement accounts or IRAs. Investors may continue contributing to a traditional IRA as long as they have earned income, which is great. Previously, you could only contribute until age 70 and a half when you would be forced to start withdrawing from the account, meaning your required minimum distributions. But as more people continue to work past the age of 70 and lifespans increase, it really does make sense that people want to contribute to retirement accounts for a longer period of time. Now, I mentioned earlier that in the past, savers were forced to withdraw money from their IRAs starting at age 70 and a half. Those withdrawals are called required minimum distributions, or RMDs. The SECURE Act actually pushes those forced distributions to now start at age 72. But I do want to note that required minimum distributions have been suspended for 2020 as part of the COVID aid and Relief and Economic Stimulus Act. So if you're turning 72 this year, you won't have to worry about your first distribution, but we'll hope things will get back to normal by 2021, and then your required withdrawals will begin next year. So if you're 72 this year, you do not have to take a required minimum distribution at all. This actually gives your money 18 more months with the potential to grow tax-free. However, building up large IRAs means larger RMDs in the future, which can have tax consequences when it's time to start drawing down your retirement assets. This is one of the topics that we'll want to discuss with you so that we can properly plan for a potentially higher tax bill in the future or suggest an alternative plan before we get to that point. Again, being proactive is very important as it relates to these changes. Next, we have some good news for part-time employees who also save for retirement. Employers with 401k plans must allow employees who have worked at least 500 hours for 3 consecutive years or 1,000 hours throughout the year to contribute to the plan. This is especially good for some women who may work part-time for caregiving and reasons and often have fewer retirement savings. So we're sorry to say this new legislation applies to plan years beginning in 2021, but the employer doesn't have to start counting the 500 hour per year until 2021. So employees might not be eligible until 2024. So if you're a part-time employee, check with your employer about how they will be handling the new rules. Now, this next rule change deals with how you can take money out of your savings plans. New parents may each withdraw up to $5,000 penalty-free from a retirement account for a qualified birth or adoption. Normally, there's a 10% early withdrawal penalty for people under the age of 59 and a half. To meet the requirements, the individual must take a distribution from the retirement account within 1 year of either the date of birth or the date on which the adoption of the individual under the age of 18 is finalized. So even though there will be no penalty, you may still owe taxes on that money when it's withdrawn. And of course, it means less savings for retirement. So be sure to talk to us to see if withdrawing this money is a good move based on your overall financial plan and situation. Now, not only can older workers continue contributing to IRAs, but more younger earners can start contributing with an expanded definition of earned income. Stipends and non-tuition fellowship payments to graduate and postdoctoral students count as earned income, and that means the students can contribute to IRAs, which is great news. This is really good news for students who want to begin accumulating tax-favored retirement savings. In many cases, graduate study keeps them too busy for a job that might offer a 401k plan or other types of employer savings plans. So that's a good thing for them. Now, this rule doesn't actually have to do with retirement accounts, but it is something that may help more people be able to save for retirement. Investors who have a 529 education savings plan can now withdraw up to $10,000 to repay student loans. We all know that student loan debt is a crisis in America. Hopefully this new provision will bring relief to some savers and allow them to put less money towards student debt and more money toward retirement savings. A related change is that 529 plan monies can also be used for apprenticeship programs, as long as they are registered with the Department of Labor. Some kids don't go to college or university, but still need money to finish their education. Now they can use 529 plans their families may have already funded. And in case you didn't know or had forgotten, the Tax Cuts and Jobs Act of 2017 also broadened the use of 529 plans, allowing a $10,000 per year withdrawal to cover private kindergarten through 12th grade education, which is a really nice benefit. And our last rule change in the second key is that one you might not have known about. Some employer retirement plan providers would offer planned loans through credit cards, which is generally a bad idea. Now that is now prohibited. Retirement plans are meant for savings, and you should have a good reason to withdraw the funds, not make routine purchases. So those are no longer available. Okay, undoubtedly, there are some of you who have already accomplished saving enough for retirement, so kudos to you. Now you're starting to think about the next generation and estate planning and wondering, what do we need to know about leaving our IRAs to our kids? Is that still allowed in the new rules? Because very significant changes have been made and will need to be addressed, as you'll see in just a moment. Unfortunately, the news here is not really that good. Our third key point is that your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. It used to be over their entire lifetimes. Now it's only 10 years. So not only are your retirement savings affected, but the death of the stretch IRA requires a review of your estate plan thinking and philosophy. Now, with certain exceptions, which we'll see in just a moment, beneficiaries of IRAs, including Roth IRAs, must liquidate the accounts within 10 years. Previously, IRA owners were encouraged to have younger beneficiaries because they could stretch out the distributions over the beneficiaries' lifetimes, allowing them for longer tax-free growth. Some heirs even planned to use the accounts for their own retirement, but now they must take the money out within 10 years of the death of the original owner. If the money is not taken out by the 10th year, there will be a 50% penalty assessed. Ouch. So this could have major repercussions for the beneficiary. When you withdraw that money, you'll have to report it on your income tax and pay taxes. So this could also affect the FAFSA, the FAFSA, if you have children applying for college for financial aid, and possibly limit your ability to claim certain tax credits. So there's no rule about how you draw down the account. So as long as you take it out within 10 years, so you can take it equally, you can wait 5 years, take it all out in 5 years, you have all sorts of options. But all that money has to be out by the 10th year. So planning is definitely needed, and this should include consulting with us and your tax accountant, because when we run the cash flows for our clients and we look at the tax consequences in the future, they could be very, very significant for those of you who have substantial IRA valuations. Now, as I said before, there are some exceptions to the 10-year rule, or what the IRS calls eligible designated beneficiaries. And they include surviving spouses, so your spouse can receive the IRA from the other spouse, and there's no 10-year limit there. They can continue to do their lifetime distributions. Disabled or chronically ill beneficiaries are exempt. Those who are not more than 10 years younger than the original owner are exempt, and minor children. Now, in that last case, the 10-year clock starts when they reach majority. So if your child receives the money at 15, by 18, that 10-year clock will begin for them, and that all that money will have to be taken out by the age of 28 in that particular case. For all these eligible designated beneficiaries, the Stretch IRA is mostly business as usual. The new rule also does not apply to people who have already inherited an IRA, only those inherited in 2020 or later. So if you have an inherited IRA that you received 3 years ago, 5 years ago, 7 years ago, you can continue your Stretch IRA payments without running into that 10-year rule, which is pretty nice. So you've been grandfathered. The real lesson from all these changes, particularly the death of the Stretch IRA, is that tax planning is more important than ever. Congress is looking for ways to increase revenue, and one way to do that is to eliminate tax breaks. So we may see other changes before the time comes for you to retire to pass on your estate. So for many years, even decades, people were told to rely on IRAs, and many Americans listened, to the point where, helped by a 10-year bull run, they have a lot of money invested in these tax-deferred accounts. The problem is, one day the tax bill will come due, and you can't predict what the tax law will be when it does. I would imagine that the tax rates will probably be higher in the future, and maybe much higher due to the trillions of dollars spent by the government to stimulate the economy due to COVID. Now, as I've said, we're not CPAs, but we can look at your investments and savings and help you plan ahead. Taxes and retirement are a much bigger issue than many people realize. We're here to help you develop that retirement income plan so that you draw down your accounts in a tax-smart way. Some of our strategies might include Roth conversions, managing your tax brackets, life insurance, reviewing your beneficiaries, including the trusts, and creating an estate plan that makes the best sense for everyone in your life. Now, regarding estate planning, you will most certainly want to review your beneficiaries as it relates to your trust. If you're leaving IRA assets to your children or a charity that are named in your trust, then you will want to consider getting that updated or changed. If your trust does not qualify as a see-through trust, then it's possible that your beneficiaries may not even be able to defer their inheritance for the 10 years, meaning that all the assets would need to be paid out in one calendar year and taxed that year. Also, if you set up an inherited IRA trust for your beneficiaries, this trust will no longer function the way you intended, and that will need to be updated as well. Now, regarding charities, if you name a charity as part beneficiary on your IRA, then you may want to consider changing how you go about this. So for example, let's say you have two children and you want to leave the majority of your IRA to them, but also include a charity. So let's say you name 10% of your charity on your IRA and the remaining amounts are left equally to your children. So if you do this, then your children will have no choice but to take 100% of their distribution in the year that you pass and will not be able to stretch for the next 10 years. Instead, you may want to consider having a separate account that is designed just for the charity, while the other account is designed just for your children. So instead of having one account with the charity and your 2 children as beneficiaries, you would have 2 accounts. One account would be the charity, which would be the contingent beneficiary to the charity, and it would be any dollar amount that you set there. And then the other account would be set up as contingent for the 2 children 50-50, because you don't want to inadvertently pay out all that money to your heirs and have them be taxed all at one time in 1 calendar year. We want to provide them at least some measure of tax control. And these are all things that we can review with you. And many of you, we've already done this, but we know we're identifying many of our clients who really need to have this looked at. And at the end of the presentation, of course, if you'd like to email us or reach out to us, of course, we're here for you to help you make sense of this and see what's going to be best for you and your situation. Now, hopefully I conveyed to you the importance of the new retirement rules brought by the Secure Act, and you can see that this legislation is really something that actually affects your life. So you're probably wondering what your next steps are. First, let's take a look at the key points that we've covered. Now, we started the presentation by saying the Secure Act changes the retirement rules, and that means current and future retirement plans need to be reviewed and adjusted. Our first key point, businesses have more incentive to create retirement plans for employees and promote participation. Our second key point is you now have more time to save for retirement, so more ways to save and more ways to use the funds. Our third and final point is that your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. In particular, for larger sized IRA accounts, new planning strategies will need to be considered in order to avoid or minimize potentially significant tax consequences. Also, your estate planning documents may need to be updated, modified, or completely changed. So thank you for your time today. I know this is a lot of information that we covered. So if you have any questions, please feel free to reach out to me by emailing me or calling us. We know that everyone's situation is unique and requires a personal discussion. So if you're a client at TL Financial Group, then it's most likely we've discussed this with you already or we're in the process of doing so. If you're not currently a client and would like to have a private conversation about your situation, please contact our office to set up a 30-minute phone or Zoom conference call. There's no cost for this call because we're just here to help. We're also accepting and helping new clients, so please feel free to tell a friend, colleague, or family member about us. We're still working remotely, but operating in a very efficient manner. We have more topical webinars planned in the next few weeks. You'll be notified by email on those future dates. They will also be posted to our website or Facebook page. A copy of this will be emailed out to everybody. And again, you can access this on our Facebook page. You just have to go to our Facebook page at TL Financial Group to follow us, and you can watch a replay of the presentation as well. With that, I want to thank you for your time today. Thank you again. Have a great day. Be safe and be healthy, and look out for our next webinar. Thank you.